Why it's important for everyone to start investing. Imagine you have $10,000 under your mattress since 2014. Now picture this. Inflation has been eating away at that money for 10 years. You still have $10,000, but it buys less than it did in 2014. Guess how much you need this year to buy what $10,000 could 10 years ago? $13,200. Officially, inflation has exceeded 32% during this period, even for the most stable currency in the world. While we can't control inflation, we can protect our capital from it by ensuring our money generates more money. The truth is that investing in securities doesn't guarantee consistent growth. There can be sharp rises and sudden falls. The stock market offers no guarantees, and investments aren't insured. Against this backdrop, deposits may seem like a good option, but they only partially protect against official inflation. Real price increases often outpace official inflation, as many goods and services become more expensive faster than average prices rise. Investing is a chance to increase the returns on your investments and try to keep up with real inflation. The most effective way to grow your investments is to diversify them. Keep some in deposits and some in investments. If one tool unexpectedly incurs a loss, the income from others will compensate. What are the stock exchange and broker? The stock exchange is like a market, like a vegetable market, but instead of vegetables, securities and other assets like currencies are sold. The stock exchange organizes trading and ensures everything is sold legally and fairly. Each country usually has its own exchange, often more than one. To access the stock exchange, an ordinary investor needs an intermediary, a broker. A broker is a company that has all the necessary licenses for the exchange, adheres to its rules, and pays its fees. The broker provides private investors access to the exchange and charges a commission for this service. An investor opens an account with a broker, deposits money, and tells the broker what and how much to buy or sell on the exchange. You can choose a suitable broker, sign a contract, and gain access to the exchange within a day. Through a special program, personal account in a browser or a smartphone app, securities no longer exist in physical form, only electronically. What can you buy on the exchange? There are many different departments on the exchange, called markets. On these markets, you can buy and sell stocks, currencies, precious metals, and even grains. What to invest in? First, bonds. Buying a bond means lending money to a government or company at interest. Suppose a company wants to expand production and needs money. The investor lends money to the company and receives a bond in return, a promissory note indicating how much money the company borrowed, how much it must repay, and when. Bonds typically pay coupons or interest periodically, such as every 6 months or monthly. Bonds benefit the company. It can borrow money at a lower interest rate than a bank. Investors also benefit. They can invest money at a higher interest rate than a bank. Usually, the more reliable the borrower, the lower the interest rate they offer. Governments, companies, and regions can issue bonds. Government bonds are the safest but offer returns similar to deposits. Second, stocks. A stock is a share of a company, a stake in its business. When you buy a stock, you become a co-owner of the company and can claim a portion of its profits. Stockholders have two ways to earn: through price differences, buy low, sell high, or dividends, when the company shares part of its profits with stockholders. Imagine you have a friend who's a farmer and offers you to buy a goat together. Your share of the goat is a stock. The goat will produce milk, which will be sold. You'll receive half the profit from milk sales. This milk profit is your dividends. If the goat's market value doubles and you sell your share to another investor, you profit from the price increase, but you no longer receive regular dividends. Stocks can yield high returns, tens, sometimes hundreds of % annually. However, the risks are evident. Like a goat, a company's business can fall ill or demand for milk can drop for external reasons. In such cases, the share will bring less profit, and selling it for at least the same money will be difficult. Nobody wants to buy an unprofitable goat. Stock prices can rise and fall. A company might cut or stop paying dividends. Third, exchange-traded funds, ETFs. Suppose you want to buy a stake not just in a goat, but in every animal on the farm, but you don't have enough money to buy half of each animal. ETFs are for such cases. They've already bought a share of each animal and offer investors, you, a stake in their share. If you buy 10% of this fund, you automatically own 10% of everything in the fund. The fund's portfolio can consist of stocks or bonds from different companies or track the price of a commodity like gold. Each fund determines its portfolio formation principle and strategy. Funds divide their assets into equal shares, stocks or units, traded on the exchange like regular stocks. If a fund's assets appreciate, the shares increase. If the assets depreciate, the shares decrease. Such funds also receive bond coupons and stock dividends they own. The advantage of such an instrument is lower risk than buying individual bonds and stocks. If one asset loses value, other assets' income covers the loss. The downside is that fund investments aren't as flexible as individual bonds and stocks. Additionally, funds have expenses, reducing investor returns, and the management company might change its strategy. Conclusion. The stock exchange is a vast marketplace where stocks, bonds, and more are traded. A broker is an intermediary through which an ordinary private investor can access the exchange. Bonds are promissory notes. Through bonds, companies and governments borrow money at interest. Stocks are company shares. Stock prices can rise and fall, and stockholders can receive dividends. ETFs are funds that have bought many different stocks or bonds. If an investor owns a share in a fund, they own a share of all the fund's assets. Thank you for watching. Subscribe to our channel to learn more about essential money matters. Keep in mind, the wise use money as a tool, while the foolish chase it as an end in itself.